In terms of the moves on interest rates as well, obviously the Fed is in the enviable position that it has growth, that it had strong growth in the tail end of last year. It's still got a couple of percent handle now. We don't have that luxury in Europe at the moment. Whether we are mildly in recession or mildly in expansion territory, it's there or thereabouts on the flat line as well. Robert Holtzman, I mentioned this last night in a conversation with you, actually. He's gone from uber hawk to, yeah, we could potentially go in June, but it's best to go together with the Fed and other central banks as well. It almost buys cover for each other as well. But the Europeans arguably need to go more aggressively and quicker. And that's what the bond market is saying, with the Bund at 2.36%, the 10-year Treasuries at 4.311 last time I looked as well. Europe needs to go sooner rather than later, yeah?
I think the case for cutting in Europe is definitely stronger, and I would say both in the euro area and in the UK, because you have not just declining inflation, but as you say, you also have a pretty soft economy. Now, how much softer than in the US, I think depends on where you look. On GDP, the gap is big. On labor market performance, another measure of real activity that's important, the gap isn't that big. The European labor market's still done fine. But I do think that the case for cutting, and cutting consecutively, cutting in June and then continuing to go at subsequent meetings, I think is quite strong. We'll find out whether the Governing Council of the ECB will actually do consecutive cuts. It's our call, but I think there's a debate about that. It's fairly clear, I think, that they're converging to a June starting point, and then how quickly they go, we'll have to see. But our expectation is that they'll actually move relatively quickly.
Yeah, and look, many of us observers and participants in the market have, quite frankly, we've all got it a little bit wrong in terms of the speed with which the Federal Reserve and the ECB and others will be cutting as well. And given what Kashkari is saying, is there a danger, actually, that the markets will have an episode, a wobble, and you're a great student of these markets, both at the turn of the century and in 2007, 2008 as well. Is there a danger that we'll have an episode in the markets, and we're beginning to see a little bit of a wobble last 24 hours, last 48 hours, because central banks don't move quickly enough?
Well, wobbles are almost inevitable. I mean, we're living in this, news over supply environment or oversaturation, and of course markets respond to everything. And if central banks were to go a little bit earlier or a little bit later, of course it's going to have effects on markets. Whether those effects ultimately amount to much in terms of the impact on the economy, that's much less clear. I mean, in the US in particular, I think there's a good case for rate cuts, as Chair Powell has outlined. If inflation gets back to the target, then we no longer have a need for a 5 handle on the federal funds rate. That's a very intuitive and sensible case for bringing the funds rate down. But at the same time, rate cuts are a little bit optional in the sense that the economy looks pretty solid. So if the funds rate stayed at the current level a little bit longer, I don't think it'd be the end of the world.